Welcome, everybody. This is Axel Merk, President and Chief Investment Officer of Merk Investments. As I record this today on Monday, the 10th of December, the glass is half empty with many investors. The UK has been in the news with the postponement of the vote on Brexit. And everybody seems to think that the UK is coming to an end, Italy is coming to an end. Indeed, this isn't just some hearsay. The Fed rate hike expectations have come down quite substantially of late, with less than certainty of a rate hike next week, and then less than 50% of a chance of a rate hike in next year. Now, this is a few hours later. Rate hike expectations have recovered somewhat, but still, overall, quite a pessimistic look of where we are. And why do you care? Why should we care? Well, if indeed the economy is turning over, historically in bear markets, the S&P has done very poorly. Now, keep in mind that we've had many years of a bull market, and it is perfectly feasible that the stock market tumbles before we have a bear market. So obviously, there's no guarantee it's going to last that long. In '87, we probably have the best known event when we had a bear market without a recession. But people are nervous and people want to have answers, and so we don't have a crystal ball, but I do have here a mouse that doesn't work. Here we go. Let me here go through the business cycle chart book and give you some thoughts, out of the box thoughts. The analysis provided in the bottom is provided by Nick. For a comprehensive year outlook for 2019, please go to our website for a replay of our webinar and the slide book we used for that. Leading economic indicators show a bit of a slowdown, but still in expansionary territory. The yield curve steepness, that's been mesmerizing, quote unquote, everybody. Gary Schilling, as I talk today, spoke this morning on Bloomberg Radio. I heard him say that every recession has been preceded by an inversion of the yield curve. And he is technically right, but only to the extent that, sure, every economic expansion is at some point followed by a recession. But if you look in the mid-60s, for example, we had an inversion of the yield curve and we did not have a recession. And even when we had it, which is commonly the case, it does take quite some time usually before you have a recession. And so make sure that just because the yield curve inverts doesn't mean all hell is breaking loose type of thing. I've argued that there's a reason why the yield curve inverts is because inflationary pressures are usually rising, and the Federal Reserve is kind of bound to start hiking rates and put the foot on the brakes. And at least as I'm talking right now, it seems that the Federal Reserve is going to say, oh my God, we're doing too much. I am not there yet, suggesting that the Fed is done hiking. The Federal Reserve business is not to manage the S&P 500. And clearly, some indicators suggest we're getting late in tooth on the market, but purchasing manager indices in the US, to continue here, look just fine. Europe and the rest of the world is a bit of a mixed picture. Italy is now below 50, the magic line that might suggest a recession coming up. Clearly, the issues in Italy are not exactly positive towards investments, but ultimately, I think what's happening there is a big game. And the reason I say it is you have a populist government that wants to stay around, and they continue to have high popularity. And when it comes to the fight with the EU, that can be settled, in my view, quite easily by privatizing some state-owned holdings. With that, they do not violate any election pledge, but then and at least as far as accounting rules are concerned, will comply with the EU guidelines and shouldn't get fined. But they have really very little incentive to do this now. They'll do this at the last minute before they get hit with a fine, or before there's kind of the official fines are formally put into place. And the other thing here, why I'm not as concerned about some others, are if you talk about Europe. I expanded on that in the outlook that provided a separate webinar. Is we had a drought in Europe, amongst others. In Germany, you couldn't ship goods along rivers, at least very little, and only very expensively. That's very unusual for Europe. The other one is new emission standards that led to many cars not being certified because the testing equipment wasn't available. That's also kind of a glitch in the system. And so a lot of that glass half full, half empty attitude, I think, is going to reverse. And then with regard to the UK, clearly the UK is a mess. But to me, the hard Brexit scenario continues to be a very remote scenario. The more likely scenario is that they make no decision. Now, no decision isn't good. It requires a kind of a postponement of the decision, I mean. It isn't good because it also holds back investments. But it is not the end of the world for the UK, for Europe, or the world economy. And so let's just keep that in mind, that some of these jitters around the world, in my view, are trumped up a little bit. Unemployment at very low levels. To me, that is really what we should focus on. Are inflationary pressures building, and will that induce the Fed to continue to move higher? And as I've argued in the past, higher rates warrant higher volatility. So it isn't so much about, depending on what you want to get out of watching these metrics, it isn't about will I identify the peak of the market, and the peak of the market is going to be exactly 3 days after recession begins. Obviously, being cynical here. No, it's a process, right? It's very difficult to know exactly when a recession begins, but what we do know is how does an economy age? And then conversely, if there are higher rates, it should warrant higher volatility. The argument I give is that when you have higher rates, you have a greater discounting of future cash flows, which makes company valuations more dependent on shorter-term earnings outlooks, because the future further out outlooks get discounted more. And so with that somewhat academic explanation, I think it makes perfect sense that volatility has increased. And as an investor, the reason I say your objectives are important is if you have a certain risk profile, well, clearly the risk has gone up in risk assets. And so that warrants a rebalancing. And even if you have a different profile in your investments, the generic investors in general, might rebalance in that sort of environment. And so it's that sort of thing that gets the bull market to gradually deteriorate, and then at some point dive over into a bear market. There's another unemployment model. Then this and the next slide, two metrics of the economy potentially running above capacity. Again, this is a sign of a late stage in an economic expansion. Doesn't mean a recession is imminent. This Atlanta GDP now indicator, you see that it's a bit noisy, but it does give a bit of a taste of where the economy might be heading. Note that this does not head into recession territory here, but yes, a slowdown may well be coming. Very important for the Fed is credit. The Fed is about credit. That's what the central banks do. They provide credit to the banking system, and obviously indirected consumer credit is relevant in that sense. Consumer is healthy. Consumer confidence is very high. Now, to me, as a contrarian indicator, that is concerning. That is a clear yellow light for the economic cycle. When everybody is euphoric, that's when you want to start to get cautious. Lending standards, in my view, most relevant when it comes to the Fed's intention to hike. The whole point of hiking rates is to tighten financial conditions. The Fed cares comparatively little to what happens to the S&P 500. So just because all the talking heads are saying that, oh my God, the Fed is going to stop, doesn't mean the Fed is going to stop. They ultimately care, is the transmission mechanism working? Is credit flowing through the economy? And for that, I'm looking here at the high yield spread. That's an indicator. It's not blowing out. Now, granted, this can blow out pretty quickly. Assume you have a downgrade wave with a lot of debt sitting at the lower end of the investment grade segment. That segment is very large, and so you could easily overwhelm the high yield segment, and spreads could blow out. Some investors on the investment grade side are not allowed to invest in junk bonds. Now, others, they may not care quite as much about the downgrade, other than they want to be out of the index funds going out. But it's not bad for risky companies to pay more for their debt. What is not good is if you're an investor that is risk averse, you suddenly learn something is risky. Now, nobody can tell me that the stuff hovering at the lower end of the investment grade side is risk free. The only relevance there is that some index funds, of course, may need to sell. Housing is slowing, and clearly, yes, of course, that's relevant on the economy, but housing is about half as important as it was before the financial crisis, simply because it's a smaller part of the economy. Here, again, please download the the chart book at merkinvestments.com/research to kind of dive into this in more detail. This is the write-up that Nick has given as a summary. Please read that offline. My own take is that, yes, we are towards the later stages of the expansion. We're not quite there yet, and importantly, I think that the Fed will continue to tighten, more so than is currently priced into the markets. But make up your own mind with these charts, other charts you have at merkinvestments.com/research. And give us feedback how you like these, and reach out to us if we can help you try to dissect what you see here. Also, if you need help with certain special situations in your portfolio, we'll be glad to discuss whether we can be of help. We can't be of help to everybody, but there are certain people we can help these days. So if you have a special situation that might warrant our attention, feel free to reach out to us. Thanks, everybody, and have a wonderful day. Talk to you next time.